Hello and welcome everyone to Budget Investing. My name is Dylan. I'm going to show you how I invest with my small budget every month and how I'm planning to grow my money long term so that I can gain some financial independence. Like so many people out there, I have only been out of school for a couple of years. I work 40 hours a week and I rent, I have student loans, so I don't have a lot of money to play with in the stock market, but I know that I need to invest, especially for the long term, to continue to grow my finances and gain that financial independence over time. Obviously, I know I need to invest my money to grow it long term, but I need to have a strategy that will work for me and with my budget. So there obviously are a ton of different strategies that I can pick from. So some of the most common strategies today are value investing, which would be finding a company that may have had some recent bad news or they had a little bit of bad luck with a particular earnings report and their value's down right now, or they've got, as I mentioned, that bad press that's pushed their price down. So they're worth a little bit less. Let's just say they're worth $5 today, but I know they've historically been worth around $10. So I'd buy that company, hold on to it, wait for it to bounce back, and then I continue to grow my money with that. And then I can sell out of it and then jump into a different company. Another one would be growth investing. So this would be buying a company that could be smaller, medium sized, or even large, but I know year over year they're going to get bigger and bigger and make me more and more money. Then you have momentum investing. So these are particular companies that have maybe had a little bit of good news recently, or there's just a lot of chatter about them, so their price is going up really fast. So this requires being super diligent and paying attention to exactly what's happening in the market at any given time, and you're jumping in and you're riding that wave up, and you're hoping to not be the last person out, so you get to make those profits and hopefully sell at the peak and make some money out of it. You have some passive investing. So this would be buying mutual funds or ETFs, something that doesn't require a lot of effort on your behalf. You just have to buy it and then you just hold it for long term and hope that as the entire economy goes up, your ETF or mutual fund goes up with it. These are usually come with a little bit of a fee as bankers or someone has to manage them, so they charge you a little bit, but they're usually fairly low. But of course, that can eat into your long-term profits. You have penny stocks. So this is obviously a very popular strategy. These are really, really small companies. So they're maybe worth a couple pennies, like 5 cents, 10 cents, and you're hoping to get in on them right before they get that good news and they really jump up really large. So if you are able to buy 1,000 shares at 1 cent and then all of a sudden they all jump up to $1, that's huge profits for you. That can be fantastic, but they're super, super risky. You can lose it all really easily, as again, they're very small companies and they're just kind of getting going. And then there's my current strategy that I'm using, and I picked it for the safety and the growth side of it, which is dividend investing, which is buying a company. They're typically larger and they pay a quarterly, sometimes even a monthly dividend, so they're just giving me cash every so often, and I get to use that money to either buy more of that particular stock or move it into somewhere else, or if I need to, I can pull that money out and invest it into something totally different, or just spend it on my groceries that month if I need. So I'll outline some of the details as to why I've chosen this as my preferred method of investing and why I think it is set up for long-term financial success. So from 1930 all the way to 2017, dividends have accounted for about 42% of the return in the S&P 500, which is a crazy amount. As you can see on this chart here, over the different decades, dividends have played they've had a different weighting within the economy, and it's always a fairly large portion. So what you can gather from this chart is that dividends play a large factor in the economy. Of course, the economy will go up and down year to year and even day to day, but those dividends that I'm going to receive are going to be what I use to reinvest into all of the different stocks that I want to hold. As you can see here, dividend growth stocks have outperformed the total stock market over time. Dividend stocks typically return about 9.25% a year, which beats the S&P 500, which is around 7.7% annual return. And the S&P 500 does pay out a 2.6% yield or dividend, which is still decent, but that is a pretty large difference. The reason why I say it's a pretty large difference is because if you obviously add the 7.5% return and the 2.6% yield from the S&P 500, you're getting about 9.5, maybe 10% on the high end, of course, changing year to year. Whereas if you get 9.25% from a dividend growth stock on average, plus now you're adding in that dividend yield that they're giving you, which of course can range anywhere from 0.5% and be as high as 5.5%, 6%, depending on the company. There's just a lot more opportunity for growth there over the long term. Another key piece with dividend investing is the volatility. The economy, of course, moves up and down all the time. But just looking at this chart here, you can see in the top row here that dividend growers typically have a little bit less volatility. Things tend to just stay a little bit more stable over the long term. So this is going from 1972 all up to 2017. So, of course, it gives just an average return over that time. So dividend growers typically had about a 10% return over that time. Their beta, so just how volatile they were over that time, is of course the lowest on this entire scale across all of the different areas. And the standard deviation was a little bit smaller, so just meaning that they, again, didn't move as much. They tend to stay in that area and continue to move up over time, and they didn't have that crazy swing up and down. Because for a company to be a dividend growing company and to sustainably increase their dividend over time, they need to have a strong foundation so that any little blips in the world don't cause them to plummet really quickly. Now let's just watch a quick interview from Kevin O'Leary. He's one of the biggest investors in the world, and he's a huge proponent of dividend stocks. And let's just see what his thoughts are on them.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company. I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked. It's just a rotating door where management extracts capital, never returns any to shareholders. And I look at that and say to myself, why don't I just avoid that altogether? If it doesn't pay a dividend, I know that 71% of the time all the returns come from dividends. Why should I own a stock that doesn't pay a dividend? And I never will.
So really, just to recap what Kevin's saying, using the example of Yahoo, is that company at one point was growing like crazy. The value of that stock was going up and up and up. And then they just kind of stopped, and of course it went down. And unless you would have sold at the top or as it was going up, you didn't make any money. You just held that stock. But if during that time, if Yahoo would have paid you a dividend, at least you would have made the income of that dividend during that time. And you can see here on my screen right now that just last year in 2020, I made $60. I know it's not a lot of money. That doesn't make a huge difference in anyone's life, but that $60 lets me buy, a couple fairly cheap stocks, or a stock obviously that's worth $60, and like that adds up over time. And you can see, of course, the amount of money I was making month over month was growing as I was investing more money. And of course, there'll be ups and downs throughout that because not every company pays every single month. And I had a really big month in December where I made $30, and then again in January of this year I made another $31. February has been a little bit quieter, but from looking at what's going to be coming in the future, March will be another big month for me. So as of right now, with my total money put in, it's not a huge amount, but that gives me roughly one extra stock every single month, and I didn't have to do anything for it. I just held these stocks, so my money is actually working for me. So no matter what, if the economy has gotten better or if it's gotten worse since when I initially bought these stocks, I'm still making more money. So if I really needed to, I could pull that $30 out in this month. I still don't need to sell that stock to get that money. I can still have those same number of stocks at the end of the day. So why dividend growth investing versus chasing a high yield? Really, the simple version of it is I can get more money out of it long term by going for high growth versus just high yield today. So, of course, if you go for a high yield company, you can get upwards of 8, even 9% of a yield from these stocks versus, of course, going for the high growth companies, which can be as low as 0.5% or 0.6% with the Visa. Over time, I'm going to make more money with that high growth. Initially, your high yield stocks will make you more money simply because just the yield's going to be higher. But you can see in this chart, this orange line is that high growth piece. So it takes a little while. You're at 25 years, and it's really starting to pick up now, though, but because it's growing by 10% extra every year, is typically what I'm going to be hoping for. And it really starts to snowball, and you really take off, and that's where you really start to make your money. It's in that long-term piece. Of course, today you can make a little bit less money, but I'm holding these stocks for long periods of time, so I'm not in a rush to sell these companies. That's why I'm picking high-quality companies so that I can make more money in the long term as I get closer and closer to retirement. All right, so I wanted to give an example of this money starting to snowball. So this is roughly what my portfolio is worth today, which is about $8,000. This is assuming that we keep with the current economy's growth, which is about 6% annually. So I split that up, of course, over the 12 months. I contribute about $200 every month, or about $50 a week, and I'm getting about $19 a month in dividends. So that's with my portfolio getting about a 2.5% dividend yield annually. After 1 year, there's not a lot of growth that happens. I'm still only at $11,000, but hey, that's still a $3,200 increase, still only contributing $200, and I'm almost getting $30 a month from dividends. So that's pretty good growth. If I fast forward it all the way to 10 years, where hopefully we're getting a little bit more growth, I'm almost at 60 grand, which is fantastic. 10 years. That's not a ton of money, but I mean it grows. You can see it. I'm getting $156 now in dividends on average per month, which is fantastic. It just lets you buy one more extra stock or a higher value company. Again, only contributing $200 every month and hoping that the economy stays strong, growing at almost $300 in a month. Again, I didn't have to do anything for that extra money. Where we're really going to start to see the growth now is in that time. So if I go an extra 10 years, this puts me at 46 years old. I'm at $186,000, which is fantastic. That's huge growth. And now I'm getting close to $500 every single month. That's pretty fantastic. That's a lot of growth. And I get to take that extra money. I get to put it back into my company. I'm not stuck and waiting on the economy to go up or down to have more money. Again, I'm hoping that it will go up, which would give me $900 in this hypothetical. I know I'm going to get these dividends because I'm going to be having more stocks, so I can continue to get more money. And it doesn't matter if the economy goes down or up, I'm still going to keep getting these dividends, assuming that the company does not end up cutting or removing their dividend. And if they do, of course, that lets me know that that company is not doing as well, and I need to reevaluate why I hold them and maybe move that money into a different company. So if I fast forward again, right to the point where you're thinking about retiring. So for me, that's in 40 years. So I'd be about 66 years old. I'd be getting close to $2,200 in dividends. Again, I don't have to sell those companies or those stocks. I get to just keep holding it, and that's $2,000 into my pocket. I didn't have to do anything. And I'm at $800,000. Again, I'm only putting $200 in every month. I've done very little extra work. That should be a sustainable amount that I can do for 40 years. If I were to push that another 4 years, so if I were to work till I'm 70, that value jumps up to $1.18 million. So that's almost a $400,000 increase in 4 years. That's where you really get that compound effect. Things are really starting to grow super fast. I'm getting close to $3,200 in dividends. Again, I'm really making my money starting to really snowball for me. You also have to remember that this is just assuming that I kept that same dividend yield over time. This did not include any dividend growth that I could have potentially received all of these years. So there's a lot of potential for me to make even more money. Of course, there's a few misconceptions out there and just a few things that I want to point out with dividend stocks. So, of course, using the model that I just showed you, I didn't have to sell or buy anything. I just bought all my stocks today and just use the same stocks forever. Of course, I will have to make adjustments as things change. No one will know what the economy is going to look like in 5, 10, 20 years. So, of course, there'll have to be adjustments that are made. I'm not picking the highest yielding stock that I can find. High yielding stocks typically aren't dividend growth stocks. These stocks are well established. They could be something like a REIT. They just put out the same amount every single time. They're not growing, and they don't get the opportunity to use that money as growth. That's a really key piece that a lot of people tend to forget, is that if this company is paying out a super high dividend, they're not able to use that money to continue growing the company. So it's a trade-off of dividend versus growth. So you have to find that sweet spot where the company still has a lot of money at the end of the day to continue to grow, but you also want that dividend. So you have to learn to pick which stock you're using. So again, high yield is not always king. And of course, dividend stocks are always boring. That's not always true. There are a lot of companies out there that are growing very rapidly that are also growing their dividend. Apple is a fantastic example of this. Their dividend is very low. It's about 0.5% to 1%, depending on where their stock price is at on any given day. But Apple, everyone's heard of it. They're always growing. They're providing new products, and they're growing their income all the time, and they're growing their dividend at a pretty substantial pace. So they don't have to be boring. You just have to know what you're looking for. And dividend stocks are not always safe. For example, there's some oil and gas companies that are out there that have been growing their dividend for an extremely long time, and they've been very consistent, and they've had a lot of disposable income. But of course, as the economy has changed and the world has changed over the last couple of years, especially in the last year, oil and gas has suffered a lot, and these companies are now having to still pay this dividend if they want to remain seen as a great buy for their dividend. So they are in a bit of a financial pinch right now where they have to decide if they want to continue paying this extremely high dividend or if they're going to have to cut it so that they can afford to continue to grow and reinvent themselves. So there's a lot to consider. Dividends aren't perfect. There's no perfect investment, but dividends are a fantastic tool to help me grow my portfolio safely so that I can sleep safe at night and I don't have to stress about it and constantly watch the price every day, because if the economy is high or if it's low, I still get that dividend coming in every month, and I might get lucky while I get my dividend, the economy could be low, and I get the opportunity to then buy more stocks with a lower price. So it can work out quite beneficial for me in that regard. Hopefully this gave you a little insight into what my strategy looks like. In future videos, of course, I will expand upon this further. If this is something you're interested in learning about, please leave a comment, subscribe. I'd love to hear from you, and what are some topics that you'd love to learn about. So thanks so much for watching, and I'll see you soon.